Hello everyone, welcome to my channel. Today I'm going to talk about biggest tax mistakes that trigger IRS audits. Let's get into the video. An IRS audit is one of the most stressful experience a taxpayer can face. While most audits are routine and often resolved by mail, they can still cost time, money, and peace of mind. The good news is that many audits are triggered by avoidable mistakes. Understanding what raises red flags with the IRS can help you file more accurately and reduce your audit risk. In this video, I will look at the biggest tax mistakes that commonly triggers IRS audits and how to avoid them. The first one is underreporting income. One of the most common and serious mistakes is failing to report all taxable income. The IRS receives copies of income documents such as W-2, 1099, and investment statements. When the numbers you report do not match what the IRS has on file, it raises an immediate red flag. This mistake often happens with side income, freelance work, or gig economy earnings. Even if income feels small or irregular, it must be reported. How to avoid it? Keep track of all income sources and reconcile them with IRS forms before filing. If you receive a 1099, the IRS has it too. The second thing is claiming excessive deductions. Deductions are legal and encouraged, but claiming amounts that are unusually high compared to your income or profession can trigger scrutiny. This is especially true for charitable donations, business expenses, and unreimbursed employee expenses. If, for example, claiming extremely high charitable contributions relative to income may prompt the IRS to verify documentation. The way to avoid this is claim only legitimate deductions and keep receipts, acknowledgements, and records to support them. The third thing is home office deduction errors. The home office deduction is one of the most misunderstood tax benefits. Many taxpayers incorrectly claim space that is not used exclusively and regular for business, which violates IRS rules. Using a dining table or a shared family space does not qualify. How to avoid it? Ensure your home office meets IRS requirement. It must be used exclusively and regular for business. Measure accurately and keep documentation. The next thing is reporting losses year after year. Consistently reporting business losses, especially for small or home-based businesses, can signal to the IRS that your operation may be a hobby rather than a legitimate business. The IRS expects most businesses to show a profit in at least 3 out of 5 years. How to avoid it? Operate your business professionally, maintain separate finances, and document your intent to earn a profit. The fifth thing is math errors and inconsistencies. Simple math mistakes may seem minor, but they can lead to corrections, delay, or further review. Inconsistencies between forms such as Schedule C, totals not matching, reported income, can also draw attention. How to avoid it? Use tax softwares or a qualified tax professional. Double check entries before submitting your return. The sixth thing is filing late or not filing at all. Late filing and unfiled returns are high risk behaviors. The IRS pays close attention to taxpayers who fail to file on time or skip years entirely. How to avoid it? File by the deadline or request an extension. Even if you cannot pay in full, filing on time reduces penalties and keeps you compliant. The seventh thing is claiming ineligible dependents. Claiming dependents you are not legally entitled to can easily trigger an audit, especially if another taxpayer claims the same individual. Errors often occur with divorced parents, relatives, or shared custody situations. How to avoid it? Verify dependency rules carefully and ensure you meet IRS qualifications before claiming dependents. The next thing is excess vehicles and travel deduction. Large vehicle mileage or travel deductions, especially when paired with low income, can attract attention. The IRS expects deductions to align with business activity. How to avoid it? Keep mileage logs, receipts, and business purpose documentation. Only deduct expenses related to legitimate business use. The ninth thing is cash-based businesses. Businesses that deal primarily in cash, such as restaurants, salons, or contractors, face higher audit rates because cash income is harder to track and easier to underreport. How to avoid it? Maintain accurate daily records, deposit income consistently, and report all cash earnings. The next thing is round numbers on returns. Consistently reporting wrong numbers, such as exactly 5,000 in expense, can appear estimated rather than precise, which may raise suspicion. How to avoid it? Report exact amounts based on records and receipts, even if the numbers look uneven. My, in conclusion, my thoughts on this is most IRS audits are not random. They are often triggered by discrepancies, patterns, or unusual high figures that stand out compared to similar taxpayers. The best defense is accuracy, documentation, and consistency. Working with a qualified tax professional, maintaining organized records, and understanding tax rules can significantly reduce your audit risks. Remember, the goal isn't to avoid deduction, it's to claim them correctly and confidently. A careful, compliant return is your best protection against unnecessary IRS scrutiny. Thanks for watching this video and do not forget to subscribe to my channel.